Hi, it's Brenton Garron with ETF Trends and ETF Database. Today I'm joined by Mark Carlson, who is a senior investment strategist at FlexShares. On August 27th, at the virtual Kansas City Federal Reserve annual Jackson Hole Conference, Federal Reserve Chairman Jerome Powell announced a new policy for the Fed's approach to its dual mandate of employment and stable prices, or inflation. So Mark, what did the chairman and the Federal Reserve say about this new policy?
Chairman Powell introduced a flexible average inflation targeting framework that avoids setting a formula-driven goal, yet it seeks to achieve average 2% inflation and emphasizes that the Fed will allow for above 2% inflation during recovery periods following inflation sub 2% during the downward periods in order to average 2% over time. Concerning the other portion of their dual mandate, the Fed has proposed dropping specific targets for maximum employment. The new emphasis will not be a specific fixed goal for employment, and the FOMC will review and act on, quote unquote, the shortfalls of employment from its maximum level, recognizing that such assessments are necessarily uncertain and subject to revision.
Great. So we're now in the first week of September. What was the reaction in the markets last week? Were markets caught by surprise, or had the policy change sort of been telegraphed ahead of time?
Well, after the announcement or the statement came out, the initial reaction was for the Treasury yield curve to steepen. The markets appeared to have been pricing in this change in the strategy once the initial shock of COVID-19 slowdown had abated, as the yield curve had steepened since the second quarter, June 30th, with the short end of the curve trading down roughly 3 to 5 basis points, while the long end was up 3 to 5 basis points. The Fed announcement triggered some upward pressure as long yields, as the 10, 20, and 30-year yields moved up roughly 5 basis points, with both real yields and inflation break-evens moving higher. Since then, the yield curve has retraced some of that steepening. However, TIPS break-evens have continued to widen on inflation concerns by investors. The markets will be looking for some additional clarity from the FOMC regarding this forward guidance on interest rate policy and inflation strategy at its September 16th meeting.
And then, given the change in this policy, what action steps should investors be considering?
Well, in order for investors to fully appreciate where the Fed is taking monetary policy, I would like to quote directly from the FOMC's announcement. It says, quote, "The committee seeks to achieve inflation that averages 2% over time and therefore judges that," and this will be my emphasis, "following periods of when inflation has been running persistently below 2%, appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time." Because of this new statement, any forward guidance coming out of the September FOMC meeting will likely follow this framework and indicate that the Federal Reserve will maintain interest rates in the current target range until inflation reaches 2% on average for a sustained period. So the major question on investors' minds must be, one, will the Fed be successful in raising inflation? And two, if they are, what is a tolerable level of inflation and for how long of a period? Investors who believe that the Fed will be successful in sparking inflation above its 2% goal would do well to consider taking actions today to prepare their portfolios for the detrimental impacts of inflation, as it remains unknown how high the Fed will allow inflation to run before taking monetary policy actions. At FlexShares, one strategy we recommend to clients is to look at their liability obligations and then to mix and match inflation hedging asset classes against anticipated needs for spending in the future. We break down inflation into 3 investment time horizons. Short term, which is 1 to 5 years, where inflation tends to be sensitive to demand and supply shocks and to policy changes. Intermediate term, which is 5 to 15 years, where inflation tends to follow longer term business cycles. And then long term, which is 15 years or more, where demographics and innovation really drive the longer term price movements. If an investor is concerned about near-term inflation, we would recommend a mix more heavily tilted towards TIPS, Treasury Inflation Protected Securities, using vehicles like our FlexShares iBox 3-year and 5-year target duration TIPS ETFs, tickers TDTT and TDTF. These ETFs give investors inflation protection of TIPS plus control of duration, which is absolutely critical in managing interest rate risk within a portfolio. For those investors more concerned with inflation, say over the next 10 years, we would recommend a mix more weighted towards an ETF like the FlexShares Morningstar Global Upstream Natural Resource ETF. Gunner gives investors exposure to upstream supply chain through natural resource companies that own and develop natural resources like energy, industrial metals like copper, agriculture, timber, and water resources. Lastly, for long-term inflation concerns, we look to increase exposure to global infrastructure and real estate equities. Both of these asset classes have strong long-term correlations to inflation. Infrastructure revenue streams often have pass-through mechanisms linked to inflationary trends or market prices, making infrastructure firms attractive inflation hedging investments. Real estate, with their adjustable rent features, can also correlate well to inflationary pressures. The FlexShares Stocks Global Broad Infrastructure ETF, ticker NFRA, and FlexShares Global Quality Real Estate ETF, ticker GQRE, can provide investors with innovative exposure to these attractive asset classes. The key takeaway for investors regarding inflation is that if they are concerned over the increased risk of higher prices going forward, the best option available is to act now to build inflation insurance into a portfolio. If an investor waits for clear signs of inflation, the cost of that insurance will have increased substantially. A bit of insurance now will go a long way to protecting a portfolio's purchasing power in the future.
Thanks, Mark. So many great insights and takeaways we appreciate as always, and hopefully we'll be able to chat with you again soon.
Thank you.